my remarks today would say something both about fiscal and monetary policy, and to discuss the role of these two types of economic policy in the current circumstances. I mean, in the advanced economies, monetary policy, at least when we think of monetary policy in its conventional terms, is more or less restrictive by the effective lower bound. And in many countries, fiscal policy also appears to be somewhat restricted by high indebtedness. So I think this warrants questions about what an appropriate policy mix would be in such circumstances, and what the longer run potential risks would be from choosing different strategies. Now, to begin with, I would like to discuss a little bit whether there is a need for active stimulus to recover from the corona crisis. With that, I mean, is there a need for something over and above the obvious need for crisis management and just to deal with the ongoing crisis, which of course that requires adding resources into the health sector and to try to support jobs and income of people. Central banks may need to act in order to avoid fiscal crisis or turbulence in fiscal markets and so forth. But the question is there a need to do more regular stabilization policy once we have control over the pandemic? I mean, arguably there could be a full recovery without any such stimulus as soon as we have the pandemic under control. But there is also an argument for why that may not happen. I mean, there's been quite a long time now that we've been living under restrictions that have in particular impacted on certain service sectors such as retail trade and hospitality. As you can see here from the graph in the right-hand side of this slide, long-term employment seems to be on the rise. I mean, here I have data up until the third quarter last year, but it's clearly up to that point on the rise. If we look at averages for EU 27 and for the Euro area, I've also put in Ireland and the UK here, so there the increase is more muted. But given this, I think it may be difficult to recover in a reasonable time to close output gaps, coming back to potential without active stimulus, active measures. At least that would be my assessment. And I think that sort of fits in well with the first presentation that we heard by Antonio Fatas about the risk of scarring and hysteresis. So if you accept that proposition that we will probably need active measures here to get the economy back to its potential, the issue is, should that stimulus come from fiscal or monetary policy or a combination of both? Well, if we start by thinking about monetary policy, well, conventional policy, and with conventional policy, I mean changing the policy rate, which is really the sort of the risk-free rate at the sort of short end of the yield curve. That seems to be, at least in Europe, constrained by the effective lower bound at this point. Of course, there's some scope to go sort of negative and further on the negative side, but by and large, I would assess that as being quite constrained at this point. But then, of course, there is the possibility of pursuing unconventional policy, and in particular, quantitative easing or large-scale asset purchases. There are such programs ongoing. They may be expanded, maybe new programs could also be introduced. But there may be undesirable side effects connected to these kinds of programs, so something that I will come back to. And if we talk about fiscal policy, well, now, as was shown here previously, many European countries are loading up on debt simply because the need to deal with the corona crisis. So that means that active measures to stimulate the economy once the pandemic is under control will in some cases appear to be constrained by quite high debt ratios. But as has been also emphasized by several of the previous speakers here, these constraints will be mitigated by certain factors. So, and they are to some extent interrelated. So we have currently very low level of interest rates that of course makes, and with sufficiently low interest rates, even very high debt ratios will be sustainable. And of course, if interest rates can be maintained below economic growth rates, then definitely we don't risk having unsustainable or sort of explosive debt levels or debt ratios. The actions by central banks in the form of quantitative easing or in the form of large-scale purchases of government bonds is, of course, something that can contribute to maintaining a situation with low interest rates. And these purchases, they also more specifically tend to push down long-term rates, something that conventional monetary policy cannot really do. And that enables countries to lock in low interest rates and enable countries to reduce the financing costs by sort of locking in these low rates for long maturities. Something that my interpretation was that the Irish Debt Office has also managed to do in a quite effective way. So what are then the long-term risks associated with carrying out active policies on the monetary or the fiscal front? Well, starting with monetary policy, if we talk about unconventional monetary policy. So these large-scale purchases of government bonds, of course, they expose central banks to the risk of just finding it difficult to tighten monetary policy if inflation actually starts to creep up and end up significantly above target. And I interpreted what Frank O'Connor said about how investments look at this as they sort of have built into their expectations that the ECB will find it quite difficult to do this, and that's something that they then rely on in when they take their decisions. And of course, at the extreme, monetary policy decision makers may just face the choice between having to accept accelerating inflation, or act in a way that risks ending up or ending the country in a sovereign debt crisis. So that's not a very appealing situation to be in. And of course, if we look to history as a guidance, we would probably then expect the decision to end up accepting increasing inflation rather than risking to end up with a sovereign debt crisis. But that's something that would remain to be seen. And of course, at this point, we don't really see any sign of inflation pushing, or inflation increasing to the extent that we would worry about this in the short term. Now, if we talk about other types of QE measures, so of course, several central banks, they also purchase other types of financial instruments apart from government papers. So if we talk about riskier assets, such as corporate bonds, covered bonds, asset-backed securities, I mean, to begin with, is something that, of course, may distort prices in financial markets, which has negative side effects in itself, but it's also something that may expose central banks to credit risks. These are instruments that couldn't really be considered safe, even though central banks, of course, try to target the more safer varieties. So, and it's also measures, if we talk about purchases of corporate bonds, which is something both the Federal Reserve, ECB, Bank of England, Swedish Central Bank have been engaged in. I mean, those are also measures that influence credit allocation, they have potential consequences for public finances because of the credit risks. So there is an argument for why these measures are quite fiscal in nature. And that, of course, also creates some risks for central banks to engage in them. If we turn to fiscal policy, well, there is a risk, of course, if inflation takes hold and the central bank then acts in the way that is sort of foreseen, at least here in Europe, that they would tighten monetary policy, leading to an increase in interest rates. So this is something that then might create uncertainty regarding the long run sustainability of public finances, and that may create also this added pressure of pushing up risk premia, in particular on debts by sovereigns with already high initial debt levels. So that's obviously a risk. Then there may be a risk of a breakdown of fiscal policy rules, something that would be relevant for fiscal policy councils. Now getting back to some sort of medium-term objective that may prove to be difficult if fiscal stimulus involve unfunded permanent measures, and the deviation from the medium-term objective for fiscal policy becomes very large. And my experience is that active fiscal tightening is politically quite difficult. It's rarely the case that you assess the situation as a clearly overheated one. I think there is a tendency to find it difficult to argue for very active tightening. And passive tightening, just sort of relying on some sort of automatic consolidation happening from maybe just not deciding on new measures in terms of expenditures. That may take a long time, depending then the strength of the recovery and how how high you can expect economic growth to be. So in summary, I would say, or at least my assessment is that active fiscal stimulus is likely to be important for a full recovery. But so is continued monetary stimulus in the form of both low policy rates and purchases of government bonds. That's important to enable such fiscal stimulus without getting into sort of skepticism regarding long-run sustainability of public finances. Quantitative easing in the form of large-scale purchases of risky assets, I think, entail long-term risks for central banks' credibility. Ultimately, it can involve a risk for their independence if they are too much involved in decisions that have this clear fiscal flavor. And finally, regarding the type of fiscal stimulus that would be advisable in these circumstances, I mean, they should be either temporary measures or they could also be sort of funded measures. I mean, there is an argument for why you could have tax-funded increases in public investment and consumption, because public investment and consumption seem to have larger fiscal multipliers than what tax decreases seem to have. So that's also something that you could potentially use, but otherwise, of course, you risk ending up with unsound public finances, and there's still the risk for this thing to unravel also if you get inflation into the system and you can't rely on the central bank to keep public finances sustainable in the long run. So I'll stop there. Thank you.